I'm excited. We're gonna dig into home buying and the market and talk a lot about what's going on there. Rich is a rock star in the world of mortgage loan lending and works with Truist, which was SunTrust, Truist Bank, and primarily works with physician loans. And he knows all there is to know about physician loans and has lots of experience working in that area. So we're gonna dig into all that, and I'm excited to kind of go through all that sort of stuff.
And real quick, I got to make a real quick disclaimer. I work for Truist, but these thoughts and ideas are my own. They're not, Truist is not.
This is not advice.
Yes, exactly.
This is for educational purposes only.
Right.
Consult your advisor, everybody, for advice.
Yeah, consult Daniel.
Yes, if you work with us.
Yeah.
If you don't, then start working with us or find your other advisor. Yes, and we'll circle back to some scenarios too, because really it depends on your situation and the numbers can skew even more in certain situations. So, but yeah, so mortgage rates have gone way up on pretty much everything from like whether it's a 30-year, an ARM or 15-year, pretty much all the products, the rates have gone up a lot. There's not like a way around that. And the problem with it is it's like prices have not gone down like theoretically they potentially should. Because like you were saying with the buying power, in theory, if buying power goes down, prices should theoretically go down on houses, but they haven't because the inventory is so low. So that's kind of a weird situation. It's like you're paying the same price as before, but paying a
Right.
way higher interest rate.
Right.
That just crunches you even more. So it's kind of a weird market. Is there any changes around like the ARM versus 30-year versus 15-year and then the physician mortgage loan space? Like what's changed over the year? I know when we talked last, you had to put money down on some of these, like the banks got a little squirrely during COVID and we're like, we're not doing 0% anymore, right?
Right. So right now that's gone. We're back to 100% financing. And this varies from bank to bank. Just a little bit of color. Conventional loans are Fannie Mae and Freddie Mac loans. So the guidelines, the interest rates, et cetera, come from Fannie Mae, Freddie Mac. The VA, it comes from the VA. FHA comes from the Federal Housing Administration. But these doctor loans are what we call in the industry portfolio loans. So we hold the money on our portfolio. It's our money. And the bank, yes. So we service it, but we also hold the money. On a conventional loan, the money goes to Fannie Mae in the end,
the government,
even though it's serviced, by the bank. So because of that, there is more wiggle room in guidelines and in price. So the cool thing right now, historically, doctor loans at 100% financing used to have a slightly higher interest rate than a conventional loan, right? But when you put them side by side, you're doing a 5% down conventional loan, you're doing a 100% doctor loan. You have to pay PMI with a conventional loan. You don't with the doctor loan. So even if the rate was a little bit higher, it still made sense to do. But now, since interest rates have gone up, the doctor loans have stayed lower. So my rates for doctor are about 1% lower than conventional loans. So I'm like in the low 6s or high 5s.
So it's like put less down and lower interest rate.
Yeah. Because people ask me all the time, they're like, well, what's the downside? And I'm like, there isn't one now. There used to be. Yeah, there used to be. Like I could point to that. But now there's nothing. Like there's no downside. If you can do 100% loan at 1% lower interest rate, like tell me where the downside is, But we'll do like 100% financing up to $1 million. And then 5% down to 1.5, and then 10% down to 2 million. And then the other cool thing about the doctor loan is you can close prior to your start date. So you can close up to 90 days prior to the contracted start date and still go off of the income for the future doctor.
So normally you have to provide like pay stubs or proof of income essentially, and with a typical loan or conventional loan.
The typical loan, they're going to want there are some variations to this, but in a typical loan, you usually have to provide your first pay stub. So you got to start your job.
Yeah. Any other big changes? That I didn't realize that about the rates have swung the other direction.
Yeah. I mean, that is the biggest one. And I have that conversation with clients every single day because they call me and they're like, what? Like I just got a quote for a conventional loan. It was 7%. I'm like, yep.
Are ARMs low? Are ARMs about the same rate as 15?
Arms are, they're lower than fixed rates.
Yeah.
The spread isn't as much as it was in the
Y-
past,
Yeah.
just because they don't want to, but an arm right now really isn't a terrible decision
Yeah.
because most people are probably going to refinance pretty soon anyway. Experts are predicting that rate probably, this is for conventional loans, go down to like fives by the end of the year at some
Mhm.
point.
Yeah.
So if that happens, then, there might be a lot of people that refinance.
Yeah.
Uh,
ARMs are fixed for just for those that aren't clear, like fixed for a certain period of time and then they become variable interest rates. So
yeah,
a lot of times the interest rate's a little lower than fixed rate options,
right.
but then,
Then they
the trade
adjust.
off is it
Yeah,
goes variable. So if rates
right,
go higher, I mean, at the
right,
end of the day, we don't know for sure what interest rates are going to do in the future.
right. We have no idea,
We
like
like to act
zero.
like we do and make
Yeah, I
predictions.
mean,
Like, I got this.
I'm watching the market all day, every day, and I, listen to updates all the time, and I still like nobody knows,
Yeah.
and everybody's been predicting that there will be a housing, like for the past 4 years. It's been like we're at a bubble. We're about
A
to hit a bubble.
recession's coming.
Yeah, recession's coming. Recession actually might be here right now.
I mean, it could be happening, but
Yeah,
like
yeah,
could not be too. I mean,
right,
it's
right.
probable,
Yeah. But as far as the housing bubble is concerned, the way inventory is, which is, the issue you brought up, that, the keeps the values from going down. That's also the thing that's going to prevent housing bubble,
Mhm.
because there's no chance that we decline when we have this inventory issue, because those numbers are going to keep and they've shown that they've slowed down, appreciation has, but it is, still increasing. There's no bubble or drastic drop like everybody's been predicting.
Yeah. Can you have 2 physician loans through Truist?
Not through Truist. So through the Truist guideline is you can have one at a time. Okay.
Mhm.
But there is an exception where if you have over 20%, like let's say you bought one when you were a
And it's gone
resident
up.
and then it's gone up a bunch. If you have 20% equity, then you can get a second one as an exception, as long as you can qualify and afford both of them. But like crossover between banks, there's no rule that says you can't have more than one. And there's also no rule that says you can't have multiple over your lifetime. Like a lot of people think that you can only get one, and that's not true.
You're right, right, right. Yeah. I work with a lot of people that have got many over the years. So we got a question from anonymous attendee, and it's funny that we're talking about this is right after we were talking about predicting future rates. They would like to, if we could give our best guesstimate, hand wave about the chances we will get back to the old days of 10+% interest rates.
I don't think so.
Impossible? Not
No,
impossible.
no,
Never
nothing.
impossible because it's
No.
happened before.
Yeah,
Yeah. Well, so so this person obviously knows about the old days. A lot of people don't even know about the old days.
correct. Yeah,
Yeah.
like a lot of the people that call me, their only knowledge about interest rates is since '08, where it's been, 4, 3, 2%, right?
Right.
So everyone's like, 6%, that's awful.
Right.
Like the majority of my career was, like was at 6 something percent, like it's not like
Probably when
out
you
of nowhere.
started, it was 6 to 7%, right? Like,
Yeah, for sure. Yeah. So, I mean, it's not like right now we are not in an abnormal, time. It's just, we have to
yeah.
figure out that it's the new normal.
I wonder what would have to happen for it to get into the 10% range. I think if the inflation numbers keep staying steady at the rate or maybe even going a little higher for whatever reason, and the Fed keeps raising their rates, that could drive rates
Yeah.
higher to
Yeah.
the
I mean,
10%. That's the scenario, I think, short
yeah,
term.
if inflation doesn't inflation is the thing. Like the
Yeah.
inflation is the key to all of it. So if what the Fed has been doing curbs inflation, it's not going to go to 10%. And also, if we hit another recession, then they're going to have to pump money in the economy.
It'll go down, way down.
And we'll have lower rates. I don't think it's likely, but who knows? Like
Yeah, those are the two outcomes, I think, is like the overcorrection. They would, the government intervention is driving a lot of this. So it's like either they overcorrect in terms of raising the rate too high too fast, which puts us in a recession, which probably ends up in really low interest rates in the next few years. On the other hand, if the opposite happens, like they don't realize how bad inflation really is and it's not changing it or it's continuing. And then they have to keep raising it. And then that's the scenario where the 10% plus rates happen.
Yeah.
And I
Yeah.
mean, I think those are both possibilities. I think they're like low on both ends potentially.
I think we're
Um,
much closer to the Fed pushing us into a recession.
I would agree, but it's hard to say. I've made so many predictions that have been wrong over the years. So I'm not a great fortune teller. So anyway, okay. Well, so let's get into the home purchasing decision. So I'd love to talk a little bit about like the buy versus rent situation.
Yeah.
And then we could talk about the how much you can afford scenario as well. Because that's both of these I think have changed quite a bit over time.
Yeah.
So buy versus rent. I think that renting kind of gets a bad rap and it's underappreciated. And I think in certain circumstances, maybe we could paint the picture of like a scenario where we would both agree that it's like like the classic rent scenario is like you have no idea what your future looks like, lots of uncertainty, new area, like finances are, you're unsure about things, like
Yeah. Yeah.
you don't know what, maybe you're new into practice in a new area of the country and you don't have, you're, especially if maybe you're single and you don't have any family there
Right. Right.
and you've never lived in the city before and you don't have money for a down payment. So there's all this like risk potential if you were to buy. And because so renting is nice in the way that it is very, very flexible, like low commitment, low maintenance. Like you don't have to even, I mean, if you have a good deal, you don't even have to like fix things. Like you
Right.
don't, I mean, maybe you have to plunge a toilet, but like you don't have to, you don't have to like fix the broken stuff. And,
Those were the
or,
days, man, when
I
you
mean,
could
there's
just
a lot of appeal to renting.
so listen, I'm like in my job, I'm supposed to say that renting is evil, you know?
Uh,
Renting is the worst thing you could do
Never.
in your life. But, I mean, obviously, I think that there is huge benefit. Like if you compare the two, there's a huge benefit to owning.
Mhm.
But depending upon the situation, like you said, if you aren't ready to buy, don't, like
When in
you
doubt, yeah.
don't, it's not something that you should do just because you think you should. If
Mhm.
you're not entrenched in a city or you're young and you all the things you said, those are all legitimate reasons to rent. And I think young people should rent,
Mhm.
before they buy because there's a growing up to do. It's the same thing with everything. You can't just throw yourself into owning a house. There's a lot to deal with.
Right, right. We had a question I overlooked here, backtracking to the primary residence and conventional loan and physician loan and that sort of thing. And the question is, can I still get a physician loan for a new primary residence while keeping the current property and loan as a rental property?
Yes. So if the loan is with Truist, our rule would be you have to have at least 20% equity on that property to get another one through us. Okay. If it's with somebody else or with us under those circumstances, you just need to be able to qualify for both. And a lot of people think that just the fact that they're planning on renting it out will be able to count rental income to offset that mortgage. And that's not the case. If I'm going to count rental income, you need to have a history of having rentals and, show it on your tax returns and that sort of thing. So as long as you qualify, like for instance, if you're a resident and you bought a house for 200 grand and you're about to start your attending job and you want to level up, buy a $500,000 house and you want to keep that one as a rental and you're making, good money and your debt to income ratio is low, no problem. Yeah, you can definitely.
Can you buy a rental property with a physician loan?
No.
Can you buy,
There might be a bank out there that does them. I don't know.
what happens when you buy a primary residence as under a physician loan and then it magically becomes a rental property within a month or two?
That's fraud.
Bro, that's fraud.
Yeah, that's fraud. Like if they get
I
caught,
mean, like, if you're telling the truth and it's your primary residence, that's
if
kind of what
it's
I'm
so,
like, if
so if,
you've lived there a year and then it becomes a rental house.
that's fine. Like things change. Like if you bought the house, you legitimately moved in, and then a year later you got relocated or got a job at a different city and needed to, move, like that's a
Mm.
like life happens. You can't force somebody to live in a house. But if they're lying, then that's a completely different.
Yeah, so tell the truth always for sure.
Yeah,
That's
for
important.
sure.
Isn't there something in the contracts that says like it needs to be your primary residence indefinitely?
I don't
Or
know.
might
I
be
don't
making
know
that
how
up.
the mortgage reads. I mean, the main thing that they require on primary residences is you're supposed to move in within 60 days.
Okay.
So that is to give you time to do renovations or whatever, but they don't
Mm.
want you like moving in next year,
Yeah. So renting has its benefits, but I am like, all that being said about renting, I think, the lean for most people listening is that eventually you should buy. And, you know, it's kind of like when you're getting settled, once you're settled is the time to buy. And
Yeah.
because long periods of time, it's just a lot lower cost and it's your home and you get to own it and you get to make it your own and you can start to build some wealth in it. And I mean, like longer term for sure, buying is the ideal way to go. You just have to I've seen some sticky situations happen with buying a little too soon.
Yeah.
Typically, is with a physician income, you can manage through those sticky situations. But I think a better question maybe is so, like, let's say you've kind of gotten to that point of like it's time to buy, or maybe you're upgrading to a nicer home. I'd love it if we could kind of explore like what's the right amount to be budgeting for on a house. Maybe we could start with like the bank's cap.
Yeah. Yeah. Oh, and real quick, I'll just go back to the rent per own thing. So right now, a lot of people are saying, "Hey, I'm going to rent until, rates go down or prices go
Mm,
down." The bad part about that is rent is also going up, right? So if you're continually paying higher and higher amounts of rent, even if you could have, even if the interest rates and stuff are higher right now, if you were to buy something right now, you can always refinance, right? Like the average person only keeps a mortgage for 5 years. So there's a great chance that you're going to refinance out of that higher rate and be in a much better situation than if you would have rented for a certain amount of time.
I think with renting too, like there's some other caveats that are important.
Got it.
Some other important things about the rent decision. I've seen some really strange situations lately, the past few years, where the rent rates are strangely low for the price of the house. I think it's especially common in like these high inflation or where property values have appreciated really fast. I think the rent rates have just not kept pace quite as fast. And like or historically, like rent rates take longer to inflate than real estate prices. But you're starting to see rent rates go up now. And then the other weird thing with renting is like some of these areas like that have really high property tax rates, like Illinois, I think is the worst as far as property tax rates that I've ever seen. Maybe Texas has some bad areas. New Jersey's a bad state for property tax rates. That can like skew the equation a little bit, like making buying less appealing
For
potentially.
sure.
Now, in theory, like they're going to just pass that cost right on through when you rent,
Right.
but it's worth looking at all that stuff too.
Absolutely. Yeah.
So, what's the most I can get a loan for if I want
So,
to?
so when somebody asks me that question, like, because they always want to know, like, what is my max? Like, tell
Is
me
that the
my,
first question you normally get?
not the first, but like when people are getting pre-approved, that's what they want to know. They want to know what's the max I can qualify for. I mean, not everybody, like some people are budget
They
conscious.
better not be our clients. Just kidding.
No, not your clients. Your clients never say. But when they ask that question, mine is, well, what's more important is what you're comfortable paying,
Mm,
and that's different for everybody. Like it's important that you know enough about your finances to know what that number is. And I'm not the one that's going to tell you what that number is. I can find out what your max amount is, but that's doing you no favors if I'm trying to get you to do something that might not be in your best interest or might cause stress, later on in your life. And doctors have enough stress. They don't need more because of their mortgage.
Yeah. Well, let's just, for funsies, what's the max?
So the maximum, like,
if I'm making 300,000, I have no debt.
300,000, no debt.
No outsiding, because they have to take into consideration your student loans and other debt payments. But like, to simplify things, let's just assume I have no debt.
I mean, you're the sky's the limit, Daniel.
You tell me what you need.
But 300,000 with no debt, you could pretty much choose. The way that the bank looks at it is
could I get a $2 million house?
Yeah, probably.
With a $300,000 income?
Yeah, if you have no debt, probably. The maximum income that you need or the debt to income ratio is 43%. So that's the max. So if you take whatever your monthly income is times 0.43, that'll tell you like the maximum you could pay per month. But that also includes debt, because there's usually no doctor that has no debt, So you got to factor in car loans, you got to factor in credit cards, you got to factor in, anything you have a monthly payment on is going to subtract from that.
Yeah. The problem with that situation, I'm just thinking about the numbers in my head. If I'm making 300,000 and take home pay and paying for that kind of house, I imagine like if that had a $2 million house, like the mortgage payment itself is not going to cost this, but like, I think the all in cost is going to be in like the 10,000 a month, maybe range, roughly, maybe 10 to 14,000 a month range, depending on like what interest rate we use and what tax rates we use and that kind of thing.
Yeah.
So that like 10 to 14,000 a month, $2 million house, that's probably pushing like leaving like 4,000 a month, maybe 3 to 7,000 a month after the house. So in other words, you have 3 to 7,000 a month to spend on everything else, including saving for your future.
Yeah.
You can make do, like you could probably afford it. And I think that's my point in bringing this up is I think that's what the bank is going to look at. They want to make sure you're able to make the payment, and they don't have the time to go through your financial situation, or that's not their job really, to go through your financial situation. You're just looking at what you're going to be able to afford, assuming that's all you have. And that's what house poor is, I think, in my definition is.
For sure. And it might not be 2 million. It might be like 1.5 or something like that.
A lot.
Yeah, it's a lot, but you don't need that.
You may want that.
You may want that, but
and there's high cost living areas and that kind of thing.
But I can't tell people, it has to be their decision. I can, I can, say that all I want, but I still have people that are like, no, I want as much as you can.
You're not the boss.
Yeah, exactly.
Yeah. What's also interesting to me about the how much can you afford question is a lot of people have like rules of thumb they talk about, and that's, it's okay to have a rule of thumb. It can be good in some cases, but like they haven't really changed their rules of thumb as like some of these huge things, like the interest rates, for example, have a massive effect on what you can afford. But like, we're not really taking that into consideration necessarily. Or, the question is, are you taking that into consideration if you're considering buying, the fact that it's a massively different cost breakdown? I was looking at the numbers for the $2 million house earlier. And if it's like, if I had a 10,000 a month budget for all in house costs, it would, at a 3% interest rate, I could afford the $2 million house at 10,000 a month all in. But if it was 7%, it'd have to be 1.3 million.
Right.
So it's like $700,000 massive, just because the rate went up.
Yeah. Yeah. So, you can't look at it from a cost point of view. You have to look at it from a monthly, not a purchase price point of view. You have to look at it from a monthly cost point of view, and then figure out, that's why I asked that question. What is your number? And then I can work backwards and figure out where they should be. Depending upon what the interest rate is, that could be different, but you need to look at it from a monthly payment point of view, not a purchase price point of view.
Right.
You know what your monthly payment is, then you can look at the purchase prices and see what's in that range, and if those will suit your needs or not.
Yeah. I think what it comes down to is having a financial plan, which is what we do every day. That's like our day job in our world, is helping people have a financial plan. Basically, all a financial plan is like a plan for your money. So like, how much is coming in? Where's it going? What's most important to you? So, what happens with the house decision is a lot of times people are like, I want to travel. Family's important. I want to retire soon, ASAP preferably. And I want the $2 million house.
Yeah.
It's like, no, you can't do all that. So
No.
then it's like, okay, well, let's prioritize stuff. And it's like, okay, family's most important, then traveling, then maybe retiring at a reasonable age. And then maybe we find out that the house is maybe fourth on the list or something. So it's like, what a lot of times the missing exercise people fail to do when they don't have a financial plan is often they don't think through it like that. They get emotionally tied up in the decision of the house and they forget those really important other priorities, and they don't like carve that money out. That's why they say save first, spend the rest.
Right.
It's like, you got to like carve out the long-term savings.
Yeah.
You got to carve out the money to travel. You got to carve out all that like important stuff first, and then see what's like left over after like eating and lifestyle and that kind of thing. And that's how you back into the house number. That's like the ideal way to do it, is you kind of back in to the house.
Yes.
Unless I'm sure there's some people maybe listening that are like, actually, the house is absolute most important to me. Like, and that's all I care about.
Yeah. If that's the case, then that's a different, story for sure.
In that case, it's like, no, Rich, like, show me the max.
Everybody has different priorities, but what you said was knowing your financial plan. Like, that's the whole thing, because that way you can set your priorities and figure out what is most important. But if you don't know your numbers, if you don't know, you need to know what everything is going to cost, utilities, internet, cable, you need to know what that, groceries, you need to know what that whole package is going to be like. And I will say this, like, any of the people that come to me from you, they always have a plan. And a lot of times they're like, hey, I want Daniel or my financial planner to look at my stuff. I want them to give me, their opinion. And to me, like, some mortgage guys don't like it when there's a financial planner dictating things, but I love it, man. Like, because they're coming into it knowing, what they should know, and with somebody who has their best interests at heart.
Yeah. So if you work with us and you don't feel confident in those numbers, just let us know and we can help you crunch those numbers, especially if you're approaching a decision around this. And if you're a DIYer and you don't have a plan, this is just like a reminder or incentive, I guess. Like, you want to for sure do that before you, I guess really the time to do it is to have a plan before you set your budget, because, that's the hard question. It's like, how much are you going to spend? And you definitely don't want to start looking. The temptation is to look at houses before you have a budget.
No. Yeah, that's a problem. And I get that all the time, where people fall in love with a house and then I've already made an offer and it was accepted.
Oh.
And then I get the application. I'm like, you don't qualify for that. Like,
and you always will. If you look at $1 million house versus $2 million, the more expensive the house, it's nicer. Like, you're going to like it.
Yes. You're going to want that house.
Yeah. It's not, but just having that plan too, it kind of keeps your head level when you're getting into that emotional decision making.
Absolutely.
So other than that, like, having a plan is important, but let's say you got the budget and you're getting into the decision making phase. I know credit's important in terms of like getting the best deal. What is the idea? What credit score do you have to get like the best terms and everything?
So usually, and this will vary from bank to bank too, but usually 740 is the magic number. Like, we'll get the best interest rate if you have over 740.
Yeah.
There are different tiers in our program. Like, if you have you need a 720 to be able to do 100% financing. If you're between 700 and 699, you got to do 5% down. If you're between 680 and 699, you're 10% down.
Does the rate go up?
Yeah. The rate goes up, but there's also, it's kind of offset because there's a difference in the rate if you put money down.
Oh, okay.
So 100% financing, like for instance, today it was like 6%, 5% down is a 10th off of that. And then 10% down is a 10th off of that.
Yeah. We got a question. I think I apologize if I'm mispronouncing your name. It says no extra cookie for credit above 800.
No.
Congrats on credit above 800. By the way.
That's amazing. Yeah, it's amazing. The other thing I would like to point out about credit is people don't realize a lot of times that what you see at home is not what we see. So when you're pulling your credit, it's Credit Karma or any of those credit bureaus, you have a credit monitoring plan with your bank. Those numbers are going to be lower than what I see. And the reason for that is there are so many different scoring models. So what you're looking at home is like the credit card model, but there's also a car loan model and a mortgage model and unsecured loan model. So they all have different ways they look at scores, and you can't really find the mortgage model at home. So the majority of the scores that people see at home are vastly different than what I see. One tip that I'll share is myfico.com has, if you Google myfico.com mortgage scoring model, you can find a way to get those scores that the bank will see, the mortgage bank. Just a word of warning, I think they make you sign up for like a 30-day free plan. Yeah. And then they'll charge you if you don't cancel it. So make sure to cancel it. But
put it on your calendar.
Yeah. But a lot of times I'll pull somebody's credit and they'll be like, oh my God, this is way lower than what I saw. And then I'll explain it to them and tell them what they need to do to get their scores up and have them go look at their mortgage scores on my FICO before they come back to me so that I'm not, repulling credit too much.
How often do you see physicians with below the 740? I guess that's the threshold.
A lot. It's probably less than the rest of the population, in my opinion. I don't know. But especially residents or younger doctors who haven't established a lot of credit yet, that's the thing that I see the most is doctors coming right out of medical school, going into residency. They'll have nothing in their name because mom and dad, paid for everything. And that's advice that I would give is just make sure that you have 3 trade lines, 3 accounts, like credit cards, car loans, unsecured loans.
Get some debt.
We want to see 3 of those. And I'm not saying get some debt and charge it all the way up and be in the hole.
Be responsible with the debt.
Yeah. Use it for paying gas and pay it off, but establish your own credit so that you're not, because I have a lot of residents that come to me and they have no trade lines. They might have a good credit score, but I need to see that they have 3 trade lines that they've been paying on for 12 months. If they don't, I can build non-traditional trade lines through cell phone bill or utilities. But a lot of times those are in dad's or mom's name. So if I don't have any of that, then I got to say, hey, go work on it and come back later. So that's something that I would recommend is, establishing credit early.
Yeah, it's worth understanding what your credit is. I think, it sounds like the number is sometimes difficult to get, and converting it between your score and that score or whatever.
Yeah.
But there's some easy things you can do to increase your credit. I have seen people have trouble with the debt ratio. They say they just have one credit card and they use it for everything. And the balance on it is high, but they pay it off every month. But it looks like it's 90% utilized or something like that, which hurts their credit score. But it's kind of dumb that it does that, but that's just part of the formula thing.
Right.
But you can easily either increase the credit limit or pay it off faster or whatever.
Right. So what people don't realize is that the creditor reports to the credit bureau once a month. So if American Express reports to the credit bureau on the 15th, because that's when their the payment is due. They usually report on the same day that the payment's due. And it's your balance is up there when they report it. You pay it off the next day. Well, it's not going to show that it's paid off for another 30 days. It's going to show that it's way charged up, like you said. So it's best to keep those numbers below 30% of the limit. That's kind of the rule of thumb.
When's the best time for people to be reaching out to like lenders?
Like during the month?
In relation to the time that they're going to buy, like 30 days before they buy, 60 days before they buy, or
yeah, before they buy. So a pre-approval is good for like 120 days. So like your credit report is only good for 120 days. But what I tell people is just come to me before you start looking, before you start falling in love.
Before you make an offer, for sure.
Before. Yeah. So, it only takes us a couple of days to do a pre-approval. But if you fall in love with the house and you need it yesterday, and then, we got to put you to the top of the list. And then, maybe it's not an easy pre-approval. And then it just turns into a, fire drill. But yeah, I mean, really, whenever you're about to start looking in earnest, that's when I get pre-approved, just get pre-approved and then you're off to the races.
So have a financial plan, then talk to the lender, talk to Rich. How often do people how often are people shopping rates? Like, do you get that a lot with physicians? Or are they normally just like, you're my guy?
It's a little of both. I get a lot of referral business from, realtors, and I'm a preferred lender for a couple of builders. Like usually when I get something from them, they're not shopping me, but I get a lot of business from other sources where they're getting tons and tons of quotes, or they read that they needed to get 3 quotes and that's what they're going to do. And there's nothing wrong with that. One thing I would recommend when you're shopping, for a mortgage is that you find out 2 things. You find out what their interest rate is, of course, like that's the first thing. Everyone knows that. But the second is what their lender fees are, because that can change immensely. If somebody has way higher fees and that's why they have a lower rate, like that's not comparing apples to apples.
Right.
So lender fees are the part of the closing cost that goes directly to the bank. One of those is the origination fee. So you may have heard the term points. That's like 1 point is 1% origination fee. And you really want to know that because that can add up quick, especially on your $2 million loan. So you want to know if they charge points. Typically in my quotes, I'm not charging any points. The only time I charge points is if somebody wants to buy down the rate, pay to get a lower rate. And then the other lender fees are like what the bank charges on every loan. Like we have a processing fee is what we call it, appraisal fee, credit report fee.
Yeah, there's a bunch of them.
Tax service fee. So
and
those
they should
are the
break
ones,
it down.
Yeah. So those
you
are the
should
ones
be able to
you want
ask for it too. Like we see it with a lot of people. The classic is they're like talking to they heard that you ought to talk to 3 lenders and they go to one and they're like, hey, Bob, give me some pricing. And they're like 6% interest rate. And then that's all that the email says or whatever they communicate. Yeah. And then the other one's like 6% and 1,000 closing in the email. And then the third one sends the full cost breakdown, which is more in line with what you're talking about. And then they send it to us and they're like, and maybe the full cost breakdown is like 6.5%, which is higher than the other 2. And they're like, well, I think I should go with the 6% interest rate because it's a lower rate. But the problem is like, we have no idea what the first 2, You have to have the full breakdown to know what you're even looking at. And I would not even go further with someone until I saw that full breakdown. I mean, that's good. Even if you're going to use one lender, it's just good practice to like look at the full cost.
Yeah. You should know what your costs are, but also with the full breakdown, you need to discern what the lender fees are from the rest of it, because the city and state taxes, the escrows, the title fees, those are going to wind up being exactly the same no matter who you go with.
Well, they should be.
Well, they will be.
They will eventually.
What the person estimates up front may not be, right? So I run into this a lot because I over disclose. I want the person to go to closing and pay less than what they thought what they were. So when I put all of the fees on there the way they're supposed to be, and then the other guy doesn't, like he like really lowballs all or forgets to put a title fee on there or something, even though my, my lender costs are lower, his overall costs look lower, but they're not, because in the end, those fees are going to be exactly the same no matter what. The only fees that are going to change are going to be the lender fees.
Yeah, that's confusing to look at. We've looked at them a lot, but this is all good stuff. I think we could go on and on. I know we're getting close to time, so I wanted to kind of start to wrap up and talk about some follow-up actions to think about. First of all, I've already thrown it out there. Like, our team is always happy to help with financial planning, the financial planning aspect, which I think is important in establishing that plan. Especially if you work with us, for sure, keep us in the loop. If you're not working with us, we're happy to do like a 30-minute call to talk about like pressing questions, or look at like a loan breakdown for you if you want. Like, we can do stuff like that in that 30-minute intro call, which is no cost. So make sure and look into that. Or if you're doing it yourself, like, have that plan in place. And then Rich is a great resource. What's awesome about Rich is he's already said this himself, but I'll say it too to reinforce that. Like, he's very objective. Of course he has incentive to recommend certain things to you, but like, he's a pretty objective guy. Like, he's going to tell you if he thinks that you should, be renting, or if you're spending too much or whatnot. So he's a great resource to reach out to. Rich, can you throw out some like ways for people to get in touch with you and a little bit more about how to find you?
Yes. Richard.Ricci, Ricci at Truist.com. Yes. My name is Rich Ricci. I've heard Richie Rich maybe once or twice in my lifetime. And then you're going to put my contact info in the description, I assume. That's my email address. My website is www.truist.com/Richard.Ricci. So there's kind of how you can, get in touch with me.
Awesome. Well, it's been fun. And I'll throw in a link to this mortgage all-in calculator that we have that's really helpful to kind of look at cost breakdowns as well. Any other resources or suggestions you can think of, Rich, that we didn't hit on?
Yeah, no, talk to a professional is my opinion.
And talk early. And Rich is not aggressive either. Like, he's not, that's partly why I like Rich as a friend, but, I professionally appreciate his non-aggressive approach. Like, some of these lenders get hyper aggressive, and I do not like that.
I've told you've sent me another estimate, and I've told you their deal's better than mine, and this is not bragging, but I do enough business where I don't need to scratch and claw for it, and I don't need to coerce people into doing business with me. It's a luxury to have that.
Yeah, it's a good spot to be in.
Yeah.
Well, it's been fun, Rich. I appreciate you coming on, and keep up the good work.
You too, my friend.